Well, for more on the outlook for oil, I'm joined by the IEA's David Fyfe in Paris. He heads the group's oil industry and markets division. Thanks very much indeed for speaking to us. Well, I guess the overarching concern that we've seen with oil on the markets in recent weeks is that a slowdown in global growth will soften demand. And I guess you're saying that that concern is justified.
Yeah, I mean, the description you just made of our demand outlook is based on our base case, which retains a fairly buoyant view on global economic activity, between 4 and 4.5% GDP growth this year and next. But we run a sensitivity which generates much weaker growth next year in oil demand, about 0.6 million barrel per day of growth, compared to our base case, which is about 1.6 million barrels per day of growth for 2012. So there's obviously this is a market that is highly sensitive to income, arguably much more so than price. And so the risk is very clearly there. But by definition, our base case remains the higher GDP case until we see more evidence that this is going to really slow down economic activity markedly.
All right, well, let me then ask you about the IEA's lower growth scenario. I think you alluded to it just there, in which oil demand increases by less than the anticipated amount next year. How likely is this scenario?
We're putting it front and central as a clear possibility, given what we've seen over the past couple of weeks and concerns within the market about sovereign debt and so on. So it's very clearly there as a possibility. But as I said, by definition, we're still running our base case as the slightly more likely. But I think, the likelihood of a demand slowdown based on weaker economic growth has obviously increased over recent weeks.
Yeah, and I mean, the U.S. debt ceiling negotiations, the sort of dragged out, protracted nature of that deal, it took a very long time to get there. That was negative for the oil markets, really, for most asset classes. Since we had a deal, I mean, that has been a positive, but nevertheless, those underlying concerns still very much there, along with sovereign debt issues right here in Europe. How is this going to impact the oil market going forward?
Yeah, I mean, we've seen quite a sharp sell-off for oil, but also for other commodities. And, looking forward, prices are going to be heavily tied into those economic expectations. Over the past 2.5 years, we've seen a fairly close correlation between economic activity and expectations for growth and equity markets and crude prices. And, I would expect that that's likely to continue going forward. But, our base case still remains one in which the market is looking for 30 million barrels per day or more from OPEC.
And I mean, are you concerned about OPEC potentially cutting production? A very quick response from you, if you would.
Well, I think the interesting thing is that both ourselves and OPEC have a similar underlying call on OPEC crude for next year, which is between 30 and 31 million barrels per day. So that's at least as much as they're producing currently. We would hope they would be looking at their own figures and acting accordingly.
Got it. David Fyfe of the International Energy Agency, thank you very much indeed.